Welcome back to my discussion on corporations. Don't you agree? This feels like the land of 10,000 topics, this corporation chapter. Well, let's have a good attitude and get going again. What is our discussion going to be on today? One that I like a lot, Treasury Stock. I like the topic of Treasury Stock, and I like the way the new cartridge on my pen is working. Hopefully it's looking better to you. So, we're going to learn about the accounting for Treasury Stock today. Let's do the who, what, where, when, and why thing with this, shall we? What is Treasury Stock? Treasury stock is not stock in the United States government. They don't issue that yet. Ha! It is stock of your own, however, that you've issued in the past and that you are buying back now, maybe on the open market or maybe from direct owners. Second question is why? Why would you buy back Treasury stock? Well, why could be answered by saying, one, you might want to support the market. Nothing makes the price of your stock tank more than not being able to unload it if someone wants to. If you provide a ready market, it always has a place it can be purchased. Another is you might increase your net assets by buying low and selling high. You'd never record a gain or loss with your own stock transactions, but you could buy it for less and sell it for more, thereby increasing your assets. We'll see the accounting for that. Another one's far more entertaining. Could prevent a hostile takeover. All someone has to do to take you over if you're a corporation is buy enough of your stock that they can vote you out and wazoo, you're out of a job. So you can buy up all your stock that's out there and then they can't get it. That's a juicy story. And another very reasonable reason to buy it and then give it to your employees, part of ESOPs, employee stock option plans. Wow, now there's some tricky accounting you'll learn in your advanced classes. So when you buy Treasury stock, where does it go? We're going to start with 3 transactions. First, you buy 1,000 shares of your own stock, open marketplace for $20 a share. And then in the future, You sell 300 of those shares for $22 each. But look at that, a gain. 20 minus 22, you're making $2 a share. And then finally, you sell 300 for $15 each. Yikes! You bought it for 20 and sold for 15. Not exactly what you had in mind. Crikey, mate. Suffered a loss. But remember, no gains and losses can be showed on the income statement, so let's make the journal entries and see how we make this work and still stay off the income statement. Starting with transaction 1, buy 1,000 shares for $20 each. You're going to debit Treasury Stock for $20 a share, and watch, this starts to act like par value almost. 1,000 times 20 is 20,000 bucks, and you pay cash for it. Notice Treasury Stock has a debit balance because it's a contra account to owner's equity. It's contra to the whole total, not any one account. The method I'm teaching you here is called the cost method of accounting for Treasury Stock. There is another method, but we don't use it in this book. And in the cost method, Treasury Stock's a reduction of stockholders' equity. Moving on. We sell 300 of these for $2,200 each. Yay! That's our gain. You get cash of 300 times the 22 bucks, so you get $6,600 right in the checking account. Some has to come out of Treasury Stock because you sold it, and if you recall, it went in Treasury Stock at $20 a share, and it needs to come out $20 a share. 300 times 26,000, and you've had a gain, but we can't call it a gain. We put it in a you've got it, paid in capital from Treasury Stock transactions shown in the paid in capital section of the balance sheet. So we had a gain. It drove assets up. It increased them by 600 more than we paid, but we didn't call it that. We just capitalized it and put it on the balance sheet in stockholders' equity in this lovely account. Now we sell 300 for $15 each. The bad side of the stock market. 300 times $15 each is a bummer, and it's also $4,500. I'm going to drop down a little bit for my Treasury Stock hit, because it needs to come out of Treasury Stock, and it has to come out of Treasury Stock at $20 each. Doesn't that kind of act like par? 300 times 20 is another $6,000 decrease in Treasury Stock. What do we do with that loss of $1,500? Well, the first thing you do is eliminate any paid in cash from Treasury Stock transactions to the degree that they exist, and they exist, in our case, $600, assuming this is our only Treasury Stock transaction ever. And we're still $900 short of making this entry balance. It is a loss, but you can't call it a loss. But what do losses get closed into? Well, revenues, gains, expenses, and losses all get closed into retained earnings. And this is no exception. We take the loss directly to retained earnings. We don't call it a loss. It doesn't hit the income statement. We never use those terms when it comes to talking about accounting for Treasury Stock. So any shortage is going to live in retained earnings. All right. There's your example of what happens when you buy Treasury Stock. When you sell it at a gain, it creates paid-in capital. And when you sell it at a loss, it reduces paid-in capital from Treasury Stock transactions to zero, but no lower, and anything beyond that goes directly to retained earnings. Great. Let's keep our discussion going and look at what happens with Treasury Stock on the balance sheet. So then we're going to look at how reporting Treasury Stock on the balance sheet pans out. Well, where are we? Not so interested in lots of the sections of the balance sheet, but real interested in stockholders' equity. stockholders' equity has some sections to it. It has a paid-in capital section. It still has a paid-in capital section, a retained earnings section. Now, an unallocated reduction underneath that for treasury stock to give you a total stockholders' equity section. Let's first talk about how treasury stock affects common stock. And although it doesn't affect the amount of common stock, it affects what you write on the balance sheet. Let me write some stuff and we'll talk about it. Let's assume on our balance sheet that the par value of our stock is $10, so that would be shown, par of 10, that we've had 100,000 shares authorized by our corporate charter, and that 50,000 have been issued. Now there's going to be a difference between issued and outstanding, because in our last example, I think I messed this number up. Hold on. I got 0 happy on that number. 50,000 shares have been issued. I just made that up. We need a number there. And now 49,600 are outstanding. And that's what it would show on the balance sheet. Par 10, 100,000 issued, authorized, 50,000 issued, 49,600 outstanding. And the difference between issued and outstanding is our treasury stock. Now I'm going to show you some notes, but this wouldn't show up on the balance sheet. You had 1,000 shares, and you reissued 600 of them, so you have 400 of treasury stock that still exists, and that is the difference between issued and outstanding, the treasury stock. And in fact, down under treasury stock, it would say 400 shares are being held in the treasury. So the difference between issued and outstanding should show up on the balance sheet under treasury stock, the very number. Then we would have our normal paid-in capital section. Paid-in capital in excess of par from common stock. I want to put some numbers in here. I'm just going to make them up. But I'll make them up according to the facts. We have 49,600 outstanding. At $10 a share, we have to have 496,000 in our paid-in capital. That has to be the case. And let's just say that we sold in excess of par for 100,000. Don't look for those numbers. I just gave them to you. If you had any paid-in capital in excess of what you paid for treasury stock, it would be shown here. But as you'll recall, we didn't, because we sold it all. You don't have to put it there at zeros, but if we did, that's where it would go. And then we would have a total for our paid-in capital section. I often abbreviate it as PIC. I'll write it out now and then so you keep track of what PIC means. And in this section we have $596,000. And let's further say our retained earnings just happens to be $600,000 after everything that's happened. That's where it sits. And our treasury stock was 400 shares, and you'll recall we paid $20 a share, so we'd have 20 times 400, 4 times 2 is 8,000. So we have 8,000 here, and it would be a contra amount to stockholders' equity, unallocated at the bottom, being subtracted off, because that's how the cost method works. So you would have 596,000 plus 600,000 minus 8,000. Total stockholders' equity, 1,188,000. So let's summarize a little bit of the things I think you need to remember. 1. Treasury stock transactions change. What's issued versus what's outstanding on the balance sheet, where you're discussing that in your common stockholders equity section for us right here. Notice that they can add a layer to paid-in capital. If you had them, it would add it right here. Notice that it is a contra stockholders' equity account. If you use the cost method, which is the one we learned in this book, it's shown underneath retained earnings as a negative amount to the entire section of stockholders' equity. And finally, remember, there'll never be gains and losses shown on the income statement as a result of treasury stock transactions. Gains are picked up in paid-in capital from treasury stock accounts, and losses wipe out paid-in capital from treasury stock transactions. They take it down to zero, and if they're not big enough, then they go into retained earnings. Kind of a fun topic. Isn't corporation accounting complicated? Well, that's it for treasury stock. Thanks for joining me today. Talk to you soon.